TheoTrade. This is Don Kaufman. It's October 25th, 2019, and you are watching the TheoTrade Weekend Update. The theme this weekend? Well, prepare for a transition back to volatility. I'm going to give you some details on that front here in just a moment, but I wanted to start with a brief update specifically as regarding earnings butterflies. So we had a class just about a week ago on earnings butterflies. We have been trading quite a number of earnings butterflies this week within the chat room here at TheoTrade. All right, here are some of the results. We hit flies on Intel, on Microsoft, on Verizon, and Visa. We missed the flies on PayPal, on Tesla, on American Airlines, and First Solar. Right off the bat, you have to recognize that the type of butterflies that we're going after, well, they have less than about a 20% chance of hitting. With a little bit of knowledge about expected move, we're at 50-50. By the way, I also placed 5 butterflies the previous week, and yeah, this is it. I placed 8 butterflies, okay, this week, and literally hit 4 out of the 8. In the previous week, we placed 5 butterflies and hit 3 out of 5. It's not about the probability embedded in the butterfly. It's about the probability of hitting the edge of the expected move. To kind of give you a quick example, though, on this front, when I say we're hitting some flies, are the returns outstanding? Well, let's take a quick glance. This is a couple of different butterflies that I did specifically in Visa. So here's a Visa butterfly. Now, Visa had some pretty extreme volatility, all right? Right after their earnings announcement, stock, cratered, it rallied, it cratered, it rallied, and we rallied right into kind of the edge of that butterfly. Again, some of the results over here, well, we paid 36 cents for the butterfly. I actually got out of a few contracts at 70 cents and a few contracts at $1.05. I like to kind of stagger into positions and kind of stagger out of positions. But again, from a return perspective, I think it's quite solid. That's kind of an example here. But the point that I wanted to make is predominantly just with the number of butterflies that we're actually hitting, you have to ask yourself, is the juice worth the squeeze? And looking at some of these results after 8 flies, or if you want to add up the previous week's flies, okay, the results are outstanding thus far from the expected move butterfly. One of the key points, though, to remind everybody, if you're placing these expected move butterflies, allocation, allocation, allocation. What you allocate to one fly, you must allocate to another fly. With that, enough. We're going to put the earnings butterflies aside, of course, until next week. Because next week, yeah, we're right back into the thick of things with earnings. Let's move right on. When I talked about a moment ago, prepare for a transition back to volatility. Well, what am I really referencing? First and foremost, volumes and volatility right now, they're just dead. They're dead. But do not get caught off your game. Don't get caught off guard. Let's actually cruise over to the S&Ps, okay? So the S&Ps in today's trading session, yeah, we have a bit of a rally. But for the most part, the S&Ps are up some 16 points. That was it, people, for the week. When I say that was it, I mean, that's all we did for the entire week. And this is Friday. You expect maybe a little bit more, volume trading on Friday. We did just north of 1 million contracts. I got to zoom out, for example, to a daily chart here. Don't worry about up here. Worry about for just a second right in here. Okay. What are we looking at in here? Listen, we're lucky to do 1 million contracts in the S&Ps per day. It is light out there, and we have been trapped in an incredibly tight range. Let me, for a moment, elaborate about this tight range. I'm going to pull up, in this case, I'll use like a 90-day 1 hour. Again, a 90-day 1 hour. I'm going to close up this left side bar for just a second. Okay, we saw a similar and tight range. Again, this is a contract adjustment, so pay no attention over here. We saw a similar and incredibly tight range for a tremendous amount of the month of September. October turned into Mr. Toad's wild ride until again, about the last 2 weeks, we are trapped once again in an extraordinarily tight range. The issue, okay, pertains, and I want to zoom very heavily into this. For the most part, almost all the trade that we have seen has really persisted right in the 2983 up to approximately 3010 region. Okay, so what's wrong with that? Why even mention, okay, the tight range? Listen, I am not here pointing to the chart to substantiate any type of technical pattern in any way, shape, or form, because there isn't one. And that's not why I'm spending time on this, okay? Why I'm spending time on this is to understand how tight of a range we're effectively in. The longer, the tighter the range happened to be, okay, the more violent the exit is going to be. What you're going to see right now, and that's why I say don't get caught off guard. I mean, we're trading for the most part, let's call this again, 3010 down to 2983, which is our gravity point. The longer we stay in this range, all we're doing is accumulating more and more risk in a tighter range, right? More risk. Again, accumulation, aggregation of risk. For the most part, when we come out of that range, things are going to get downright violent. Why? Because we've got a huge amount of delta risk that we're actually accumulating. If we go up, as we start to go up, right, traders are going to have to go out there and they're going to have to add positive delta. We go down, they're going to have to add negative delta. Effectively, what that means, we go up, we're going to explode higher. We come down, we're going to rip apart. And it's about, again, when people think of the term volatility, okay, volatility is most often thought of in the bearish sense, when markets are getting really volatile, but you almost have to redefine it in today's marketplace. And I think that's fair to say. Why do you almost have to redefine it? Because we do and have seen, okay, tumultuous upside moves, horrendous and fast moves to the upside. Most people don't think that things are horrendous, if you will, to the upside, but you should, okay? Because some of the moves that we've seen, all right, and this is something that's just not discussed often enough, all right, as violent are as the down moves, okay, the up moves are equally, okay, as ripping. Except in those up moves, volatility very often, that's volatility as it pertains to options, happens to effectively contract. Again, don't get caught off guard. We are wound up like a top in an incredibly tight range. I was saying the exact same thing coming out of September. We ripped apart for a couple of weeks. All of a sudden, boom, we're right back, okay, into this extraordinarily tight range. And again, I could take this even further out in time. I'm going to go to 180 day into 4 hour. And the reason that I'm zooming out 180 day, and I'll highlight this for you guys for a second, 180 day 4 hour, okay, we saw the range here. We saw the same range here. We're back in the exact same range here. Now, to say that we've broken to the upside right now, I don't believe is a fair statement. We didn't do anything to the upside. You'll see that here momentarily. For the most part, we are literally, again, accumulation of risk, accumulation of risk, accumulation of risk. And it's right in the exact same, again, that same wheelhouse of this 2983 right up to this, 3010 kind of range, peaking out as far, if you will, as 3020, which is effectively where we're currently at. So I caution you, we are expecting, okay, and you need to prepare for a transition back to volatility. However, at a time like this, please do not try to handicap whether that volatility is to the upside or effectively to the downside, because we're going to come into a binary trading week, which I'll discuss here in just a moment. All right, next in the list, well, bonds. Bonds shall come back to life. Get ready to rumble inside of the bonds. They have been dead, all right? Dead as dead can be. The last 2 weeks, we've actually seen decent size ranges, Okay, volume gone, insignificant. It's amazing. We haven't talked about bonds in almost 2 weeks after seeing some of the most wild upside moves and wild downside moves. Bonds, okay, they've mellowed out, which is exactly, okay, this here is the reason that the S&Ps are about to get rocking. Right here, the bonds are the reason, okay, that the S&Ps are going to transition back to volatility. Again, the bonds shall come back to life. Get ready to rumble in here. This is your binary kind of trade. And I'm actually going to give you a specific trade on this front in just a couple of moments. But again, you are facing the Fed a little bit later next week. So on Wednesday, we're going to have an FOMC announcement. I'll talk about that here momentarily. Okay, but if you take a look at the bonds, I believe they can be very opportunistic at this point in time. If you look specifically at the TLT, that volatility is down to, in the neighborhood of about 12%. And I'm going to pull up just IV range. Let me snap to it over here. In terms of the implied volatility range, I want you to see why I think that this is going to be advantageous. That volatility has really crushed back. Okay, we're right back down kind of to the lower end, if you will, of some of the recent volatility kind of spectrum that we've seen inside of the TLT. Again, this is what implied volatility has looked like specific to the TLT. And that's, going all the way back into the July timeframe. We're right to the lower edge of that in terms of volatility. So if you're looking for return to volatility, this is the product for you. Okay, I've actually placed, again, a infinity spread both in January and February now. Okay, there's an infinity spread, a specific infinity spread video for those of you that can access the TheoTrade archive. Look specifically for the infinity spread video done October 25th to detail that February infinity spread specifically in the TLT, because again, expect some volatility coming to a bond product near you. Next point to be made here on this weekend's update. Well, this one is about as blunt as I could possibly be. Data just sucks. But who's counting? When I'm talking about data, I'm talking about the earnings. I'm talking about a global slowdown. Okay, if you saw some of the European data this week, you really have to start shaking your head. I mean, there's a product, EFA. I've been watching this. The EFA, okay, for the most part, gives you just international exposure. So neither here nor there. I'm just going to throw this out here. Apparently, the international exposure is not being impeded by the fact that data in Germany, they're heading to a recession. Okay, data all over Europe, not good. Chinese GDP, not good. There were PMI numbers that came out throughout. I mean, I could just go on for literally half an hour. Japan, okay, everything pointing to a global slowdown. Even some of our data was just dismal. Okay. Earnings, well, need I mention more? Let's maybe talk a little bit about Amazon. How about Amazon? Okay, they bombed, they missed, they rallied. Amazon ended, okay, down on the day, only $19. Yes, in the after hours, Amazon was down to $16.18. Apparently, it's a buying opportunity. One of the points that I frequently make here at TheoTrade, no one cares about the numbers anymore. That's not what it's about. It actually relates perfectly back to the earnings butterflies. It has nothing to do anymore, like, when you talk about like Amazon, their numbers. Okay, quantitative traders are not there trying to handicap, okay, what stock valuations are going to be. Quantitative traders aren't looking at stuff like Amazon and saying like, oh yeah, their Amazon Web Services and their cloud business are doing really good. Quantitative traders, okay, are looking very often, okay, at mathematics in the marketplace that most people couldn't even dream of. But what I want you to understand about that logic is it doesn't have to do with what you think a particular stock should do. Again, there have been a few firms that have outright bombed on earnings. There was actually an article that came out specifically, because I carry a position in there, but there was an article that came out specifically on Caterpillar, okay? And it was from Barron's, and it said, okay, Caterpillar bombs on earnings. Yeah, until, by the way, this was not its earnings. Earnings were a few days ago. You can see the stock after hours traded down massively. In fact, if you do go back a few days, and it's worth kind of a gander at this. It really is, because it proves the point that the marketplace, it isn't what you think it is anymore. Look at this. They bombed. Stock traded, and again, I want you to see precisely. So the stock traded 123 in the after hours after their earnings, closed on the week 140. Okay, do you realize we're talking 15-20% differential in an underlying, right? In a matter of days on what was otherwise a horrific report that they missed, guided lower. I'm just throwing that out there. Maybe you interpreted it a little bit different, okay? But it's no longer about that handicapping what the forward future of Caterpillar is going to be, handicapping the forward future of even something like Boeing. There's so much more going on, and that's why I like to emphasize the data might suck, but who's counting? Clearly, quantitative traders, it's gripped hold, and that's why things like expected move butterflies, okay, are working. And we're going to also discuss expected moves in the overall market. Now, to continue on, dove out, dove in. Bye-bye, Mario Draghi. He is done. He's out of the contest. Mario Draghi is officially out of the ECB. That's the European Central Bank. That's why I call it dove out. Well, a dove, somebody that's fairly easy on monetary policy. Dove out and then dove in. Why? Because hello, Christine Lagarde. She's not only a dove, but she's been running the International Monetary Fund, which, by the way, international, the IMF has been downgrading global growth now for almost 2 years. What do you think she's going to do? Get ready for modern monetary policy and deeply negative rates inside of Europe. It's a party, people. With that, I've got no more on that front. By the way, I think that that's probably why some of the European products are starting to rally. Just the fact that Christine Lagarde is going to take over means monetary stimulus is coming down the pipe. All right. Next thing we've got to deal with this week, all right? This coming week, I should say. So the week large is over and done with. What is coming? All kinds of wonderful things are going to happen this next week. The biggest one, for the most part, I would suggest is none other than the FOMC. So FOMC will meet. Jerome Powell will have his press conference. And what do? It's like the groundhog, 6 more weeks of winter. Okay, we've got an employment situation. Listen, we are chock full, of data points this next week. You got PMI numbers. It's a total party in terms of data drops. I'll come back to this in a minute, because if you're thinking that the market's going to be volatile, yes, but the market isn't pricing in a lot of volatility. So the Fed's back, baby. Okay. A QE by any other name. I just threw that little note in there to remind myself. Okay. First and foremost, when the Fed comes out, I don't want you guys to think that this is going to be wildly unexpected. This page right here is the CME Fed Watch tool. If you wanted to Google it yourself, the CME Fed Watch tool, that's the Chicago Mercantile Exchange. And what you can take a look at on this site is it gives the probability right there. There it is in all of its glory. There's the probability, of a rate cut coming. So it's where we currently are. It's where we're actually headed. We're headed to 150, 175. That means 1.5 to 1.75%. So they're basically pricing in a 1/4 point cut. If you take a look at the probability side of things, it doesn't just, break it down for this meeting. Okay, so the probability for this next meeting, of course, is October 30th. There's a 93% chance of a cut. This is where rates currently are. This is where rates are giving probabilities of heading. So we have a 93% chance of a cut at this coming meeting. I don't think that's what this meeting is about. I don't think that's what the meeting is about at all. Let's close that up. Okay, and that's exactly why I elaborated, QE by any other name. First of all, the Fed is heavily involved now in what they would term open market operations. They're heavily involved in the repo market. They're going after T-bills and so forth. I mean, for the most part, what they're doing, I'm going to get an economist emailing me here in a minute. They're doing quantitative easing right now, okay? But they're not really calling it that. We haven't gotten to that point yet. QE by any other name is still QE. They're expanding their balance sheet at the bottom line, but I think they're actually going to release much more of a program. This, okay, is very likely to spark a lot of volatility in the marketplace. Okay, look for it. I believe that, again, they're going to be discussing the idea of expansion of that balance sheet. All right, onward and upward here. Contrarian in the banks. One point I want to make, okay? Bank of America specifically, I want to be a big-time contrarian in here. This thing has had a full-fledged breakout to the upside. Listen, I'm not trying to catch a top. I'm not trying to catch a bottom, but I am more than willing. Again, I am more than willing at this point in time to take a little bit of a short position. I updated this also in the in-out spread. That's the 32 half, 30 half in-out spread. I want a nice contrarian position, especially seeing how, if you take a look at the auto expected moves here, Bank of America snapped through the upside of its expected move. It literally hit the edge of the expected move on Monday, people. It is just flown to the upside. Now, again, I don't necessarily believe that I'm going to catch the absolute top in here, but I think it's a nice contrarian position to look for the banks to come in. If you're not comfortable with Bank of America, okay, you have similar situations in like Citi. It's just that doesn't do it for me nearly as much as Bank of America. You've got JP Morgan. All right, decent sized breakout inside of JP Morgan. And I could continue all day with the banks, but it's good at this point. I would look for an opportunity as to be a little bit of a contrarian of the banks. Now, let's actually kind of wrap things up with the SPX expected move. So this past week of trade, we're actually going to cruise over to the SPX now. This past week of trade, we had precisely a 37.50 move. Okay, what did we do on the week? Now, if you've ever questioned a little bit about these expected moves, first of all, okay, here's the expected move. When I say that the move is what? 37.50. Okay, that doesn't denote directional bias. That means we're going up 37.50, okay, or down 37.50. And that's exactly what we're going to do. This central line over here, that's the starting point of the week. So what did we do? We hit it. And this is one of the points that I made on last weekend's video. I said, don't you dare sell options premium, okay, that we had a much higher probability of hitting. This is an intraday chart. If you think that expected moves don't matter, that line literally drawn, okay, last Friday becomes the defining factor of precisely where the SPX closed, okay? This is a $3,000 product. The efficiency in the markets right now is absolutely uncanny, okay? And that's precisely why, okay, we're looking at a contraction of volatility again this coming week. So we're actually going to drop even further down to a $33.42 expected move over the next, okay, week of trade. There it is right there, 33.42. And I'm going to tell you something, okay? I would step back. There is no way I would sell premium. This is next week's expected move. Hey, maybe we crack higher, maybe we crack lower. But I'll tell you right now, to hit the edge of $33, that is easily done. Easily done. We just came out of a few weeks ago. We were moving $40 per trading session. Now we're not getting but $33 of expected move in an entire week. No way, no how would I sell premium in here. Again, this is what's becoming advantageous. Okay? What's this? The fact that you get a wild contraction of volatility. Okay? That positions are spooling up. That the risk, okay, is just bubbling up. Take a look how tight of a range that we've been in. At this point in time, I'm going to be a net buyer of premium coming into this next week, looking for markets to rip higher, rip lower. I'm not even necessarily getting directional in the overall S&Ps. I am being a little more directional, though, specifically inside of the banks. Listen, it's a lot to think about in this weekend's update. Nevertheless, prepare for that transition back into much more volatility. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.